One thing that Bitcoin does is, by memorizing 12 words or having 12 words written down or having a little drive, you can bring an unlimited amount of value globally. And you can make global permissionless payments, that settle in seconds or minutes, depending on exactly, if you're using, say, a higher layer or the base layer. And so I think having some percentage of net worth in Bitcoin is attractive. I think the network is going to likely continue to strengthen over the next decade. And I think that it's still under allocated to in large part because it's still poorly understood. So while, I don't think people should put their entire net worth in it, I think it's a very useful asset
Lyn
to.
Alden is an investment strategist and financial analyst known for her in-depth research and analysis. As per Alden, the Bitcoin network is secure, like really secure. For now, anyway, the amount of computing power crunching numbers to keep the network operational makes it nearly impossible for any central entity to overrun it. Alden says critics of the network are overreacting to the situation and that Bitcoin maxis, who suggested censorship of the tokens as spam, just need to let things play out. Over the long term, more consensus changes like SegWit and Taproot could be useful for optimizing the network, she says. But I think it's in a healthy state. I think it's doing what it's supposed to do. While the outlook for Bitcoin price looks pessimistic, a decisive flip of the $28,051 hurdle into a support level will invalidate the bearish thesis. This development could see Bitcoin potentially tag $30,287. The concern, according to Alden, is that Bitcoin block space might not be attractive enough long-term for people to pay a significant amount on a per-transaction basis in order to settle value there or to do other things, in which case the network becomes open to lower-cost attacks. When designers have constraints to work around, that's where innovation tends to happen, she says. For a while, people have said, why isn't there more Layer 2 activity on Bitcoin? In her previous interview, Alden highlighted why would there be when base layer transactions are like 75 cents and most people prefer to hodl their Bitcoin rather than actively spend it. Before proceeding further in this video, make sure to hit the subscribe button below for more recent updates about crypto market.
I mean, in many ways, Bitcoin's a commodity. It's like a kind of an alternative monetary commodity. And the way I would frame that is it's basically the world's most decentralized and immutable database. So if you have this kind of like distributed cloud database that nobody can control, it's kind of nation state resistant, you can basically access this ledger anywhere in the world with an internet connection. And so what that allows you to do, for example, is, if you want portable money, right? Let's say you're in Lebanon and currency blew up, you can hold gold, which works. But let's say you want to bring a lot of value globally, right? And maybe those countries will let you bring a lot of value out, maybe they won't. But for example, you can't bring a lot of gold or cash through an airport. Different countries will have restrictions on how much you can maybe just export your investments and just pull like, six, seven figures of value from that country to another country if you were to move, right? There's all sorts of frictions there. Whereas, say, gold is like the most indestructible money, but it's also kind of stuck in whatever country you own it in, especially in large amounts or without relying on, centralized third parties. So, I think the next 3 to 6 months, I don't really have an opinion on because if you get a sharp liquidity problem like we discussed in the first half of this interview, it's often not great for gold while you have negative liquidity. Um, but if you were to get either the Treasury or the Fed to kind of blink and have to start kind of reliquifying markets, that would be probably a pretty attractive environment for gold. And so, I eventually think gold will kind of break out of this like, kind of top that it's been kind of bouncing along on. I think will kind of break out into the, well into the 2000s. I just don't really have a firm view on the timeline. And I think that it's largely driven by, central bank reserve diversification, and the fact that it's still underallocated. I mean, if institutions even want a few percent of normal portfolios in gold, that would be a pretty big price driver. So I think it's in a pretty good shape.
Historically, gold has performed well during periods of high inflation or when the value of fiat currencies is declining. It has been seen as a store of value and a hedge against currency depreciation. Ultimately, gold is expected to regain value, particularly if the economy falters, prompting traders to seek both the US dollar and gold to safeguard wealth. However, profit-taking has been a prominent factor, indicating a short-term wait-and-see approach may be necessary. Alden mentioned in her tweet that disinflation just means that the rate of inflation is declining. That's different than deflation, which means prices actually go down. Within the current monetary framework, aggregate prices rarely go down. They just go up at varying rates. Former Fed Chair Ben Bernanke says there's more work ahead to control inflation. Looking forward, with labor market slack still below sustainable levels and inflation expectations modestly higher, we conclude that the Fed is unlikely to be able to avoid slowing the economy to return inflation to target, Bernanke and Blanchard wrote in the paper. As per Alden, the U.S. Treasury updated their borrowing estimates. They target over $1.4 trillion in net new borrowing during the 2 quarters from April through September 2023, with an ending cash balance target of $600 billion. Tax receipts have been coming in below their expectations.
I think for a long time the dollar is still going to be the largest currency in reserve baskets, or at least on an international scale. But I think we're basically going to increasingly see a more multipolar world, which I think also reflects the fact that global GDP has become more multipolar. So, for example, when Bretton Woods was started, for example, the United States was, the last man standing after World War II. They were over 40% of global GDP. They had the industrial base, they had the gold. Whereas as you've seen developed markets recover, and as we've seen the rise of China and India and other countries back to some meaningful percentage of global GDP, the United States' share of global GDP has gone down back to a somewhat more normal baseline. And when you look at Ray Dalio, I don't always agree with him, but he quantifies things well, and he had his whole changing world order um, kind of framework. And I think the most useful data set from that is he maps global empires on a number of metrics. So education, military, economy, reserve currency status, things like that. And what you generally see is that some of those metrics are leading indicators. So education, for example, is one of the first things to rise and then starts falling before other things. Whereas things like economy and military are kind of like coincident with the peak of that empire. And reserve currency is actually one of the most lagging things. So it doesn't actually start to really build momentum until the empire is kind of already really big. And then even as the empire is kind of past its prime in terms of, say, share of global power, the reserve currency takes a number of decades and it still is really hard to dislodge because it has all that existing network effect and momentum. And so United States in many ways is kind of in that environment where among many metrics we've already kind of are past our prime, but our dollar system is still kind of near its prime. I think it's this lagging thing. Ever since early 2022, the Federal Reserve has been doing quantitative tightening, where they're reducing their balance sheet, and then they're also separately raising rates. And so they're trying to tighten monetary conditions. If we look at the quantitative tightening, what that means is that they let some of their existing bonds mature, and then rather than reinvest those as they would, they just don't reinvest those, which means that as the Treasury needs to reissue them, some other buyer has to come in and buy them. And so the Federal Reserve is basically slowly destroying base money, and reducing their holdings of mortgage-backed securities and treasuries, which means those securities have to be absorbed by other participants in the market. It's very similar to if they were to sell them, with some minor technical differences because they don't realize, like, a loss or anything like that. They just let them mature. And that's been a liquidity drain, and liquidity drains are very correlated with kind of negative asset pricing. It's not great for markets. QE is kind of like inflation for financial assets. Um, and but that's been somewhat offset over the past 6+ months by the Treasury. So, the market did very, very poorly, especially in the first half of 2022, and extending into kind of the autumn of 2022. The market did very poorly. That's when you had just the Federal Reserve is drawing down the liquidity. And while they continue doing that since then, the Treasury started offsetting them starting around autumn of 2022, especially. And so the Treasury, like I mentioned, has this cash balance. And theirs was above target. They had more cash than usual in their Treasury General account, and we could think of that as almost like a void. They previously issued more bonds than they spent, and so they pulled in capital. They pulled in capital from the banking system and elsewhere, and they're storing it in this void that's not really being used for anything. So it actually kind of pulls liquidity out of the market while they grow that cash balance.
Okay.
Um, Now, when they start reducing that cash balance, they're starting to spend it back into the market. They're basically pulling it out of this like liquidity void and putting it back into, circulating liquidity. And so as they draw down their cash balance, it's pro liquidity.
The CoinDesk Indices trend indicator for Bitcoin and Ether shows both assets signaling downtrend, a departure from their status for the bulk of 2023. Prior backtests of the BTI and ETI show initial downtrend signals preceding subsequent declines of 47% and 60% between April and June 2022. The downturns reflect the regulatory issues and macroeconomic uncertainties, including the ongoing U.S. debt ceiling impasse that have spooked investors. Bitcoin and Ether surged over the first 4 months, $160,000 at next halving. Model counts down to new Bitcoin all-time high. A bold prediction states that Bitcoin price can gain 500% between now and April 2024. Do you agree with Lyn Alden's perspective about Bitcoin and gold performance in the near future? Share your thoughts in the comments section below. If you found this information helpful, then like this video and subscribe to our channel. We will bring you more updates in the future.